Yeah, I was like reading and going through a lot of the just like stuff online about it, like different forums and stuff, and obviously on Bigger Pockets, just and like it's something that so many people struggle with all the time. It's like
Yeah.
what you said, it's like the $1 million question.
It's pretty nuts to think about just being a new investor myself. Like as soon as you do get past that analysis paralysis part, it can only be like 4, 5, 6 deals before you have $1 million portfolio. So it actually is $1 million question.
Yeah, that's funny. I didn't think about that. I'm gonna put that into my notes. It actually is like $1 million question because, well, and then like you think about it, markets like that we work in, and like DFW and Austin, and like when your median sale price is 300,000 or 400,000, it's
Mhm.
3 deals. And it's
Yeah.
it's $1 million worth of real estate. And like, I mean, we've seen it just in the deals that we've done and how quickly people have built up $1 million net worths from investing in just a few of them. You do 2 house hacks and one like live and flip style deal, and that's your third, and
Yeah.
it's after the it's after the course of 2 years you can do it.
Mhm.
Let's see. All right. What were like some of the like main questions that I kind of wanted to go over? And by the way, like this, like the conversations like these that we do in the morning, it's really cool because like the social media people, they
Mhm.
can basically just like take this and cut out snippets of it and use it all across social, and they could take like entire long form pieces and they can like kind of like just like take and they can like spread it out across a lot of different platforms. So it's not like you have to shoot everything in one take, and like it's not like it has to be super concise and like scripted, which is cool. I like that we
Yeah.
can just
Just have a genuine conversation and
just talk about a certain topic. So like some of the concerns like I was just like looking at, and like these are questions like I had a ton of like answers to, but I'd like to hear your thoughts on too.
Mhm.
So like one of the biggest ones that I saw was how do I know my numbers on paper are going to be what I hit in real life? And like I remember going through that too, like when I
Mhm.
was first looking at my deals, like how do I know I've captured every expense? How do I know this is what the rents are going to be? How do I know this is what all of my costs are going to look like? Am I missing anything? Like that's
Mhm.
something huge. How would you go about remedying that or kind of getting that question answered? How do you know your numbers are what you'll experience in real life?
Guess you never actually know. I mean, that's why you invest. It's not. It's like Gary Keller always says. It's not like a risk that you're taking. Like you're investing. There's no risk like in investing. So like as long as you're running your numbers right, you have a good team around you, you should turn out okay. And then what you learn from that first deal, that's worth a lot more than all of your returns.
Yeah.
But as long as you're not like, you can get into the nitpicky on how to actually analyze a deal. If you're pulling rent comps from 3 highways over, then you're probably not going to hit those numbers.
Right.
But how would you answer that? How do you actually know?
And you already said it, like you never actually know like 100%, but it's important to know, I think, just as like an investor, like the business isn't super complicated. I think a lot of investors think that there's like all of these pitfalls and landmines that like they're gonna bump into. And
Mhm.
they're really not. Like if you go through, like you've got one, you can use like any of like the Bigger Pockets calculators, like they're all great. If you use like an actual calculator online, they're going to help you capture all the expenses. But like if you've got good gross income, right? Like you're looking at rental comps and you're not being crazy and outlandish, like you just say, you're not pulling a rental comp from 3 highways over. You're pulling something, right in the median. You don't have to be super conservative and get like the worst rental comp in the area. Otherwise, you'll never get a deal, right? You're going to step over a ton of deals. So get like a good median rental comp, and then just calculate insurance, vacancy, a capex reserve, a little bit of a maintenance budget, and then whatever your mortgage payment's going to be. And if you're going to hire a manager, that covers like really like 98% of what you're going to bump into. Maybe you'll have a random like pest call, or you're going to have, you're going to make the mistake of going and like ruining a door because you're trying to get it open and like you installed a keyless entry thing wrong. So you had to have like a random person come over and install something new for you. But like there's just like random
Every
stuff.
single deal, there's going to be another nitpicky item
Yeah.
like that.
Yeah. But like in general, you're going to hit 98% of your numbers if you're going ahead and just, good income, take your expenses, insurance, vacancy management, maintenance, capex, utilities, and then a management fee.
Mhm.
And will hit it. So, and it's hard. It's easy to say that, but it's definitely hard to swallow the pill and say, oh my gosh, I'm about to put like my life savings, this nest egg of cash that I've been saving for the last, 6 months or 6 years, and put it
Mhm.
into a piece of real estate. Like that's really difficult. And that kind of lends to another question, and like a coaching point almost, like I'd like to do is, like you mentioned Gary Keller, like this idea of like, all right, I'm taking this cash and I'm
Mhm.
spending it in this asset. Like, how do you get over that? Like taking this lump sum of money that you've been like pulling together for the last 6 years, just
Mhm.
example, and putting it into a piece of real estate. How do you overcome like that, I guess, trepidation?
What I talk about a lot with my clients is kind of setting the right expectation. I'm assuming that they already have their big why as to what's pulling them forward and why they're in real estate in the first place. They're not in analysis paralysis without that. They don't get to that stage. They have the how, they have the models in place. They know how the real estate investing works. So everything that you just said, they're well aware of. But how do you actually put that money to work? Or even before that, I think the answer comes before that, is starting with one small action. And the next step past analysis paralysis is actually throwing an offer out there. I think a game changer. I don't know what it does to people's mindsets, but now they're actually in the game with no model in it at all. They're emotionally invested in it. Then my phone's blowing up every couple of hours. Do we hear back? Do we hear back? Do we hear back? Do we hear back?
Yeah.
After 3 years of silence. So I think that's a big one.
Yeah.
And then right after you get past that step, you actually are under contract with like a little option period. You put $200, sweet. So you have that nest egg of 30 grand that you put your life behind. You put $200, like that little bit of skin in is crazy for these guys. And then maybe that one deal doesn't work out, but now they're ready and they've seen it. They were able to ask a lot of different questions. Just being under contract, that sparks so many different questions than just analyzing properties for the last 3 years. Like, what's earned money? What's an option period? When do I have to wire this? Oh, I have 3 days to wire it. I don't need to move forward just yet. So I think just that little bit of confidence from taking that one action step helps them actually pull the trigger and close on their first deal.
Yeah, I totally agree. And like we do that a lot with our clients, right? It's just like we go ahead, like, hey, like after we do our first intro calls, we'll say, hey, like this deal looks really good. Like, and then we'll have a client say, well, it really only works at this number for me. And it's $100,000 below the asking. It's like, shoot in the offer, just get comfortable, like submitting the offer, get comfortable with what an offer looks like and what you just said, go through all of those questions. What contingencies do I have in place, right? Like, how am I going to get my earnest money back? How am I going to get my option fee back? You're not. It's okay. It's $200, and you're going to go through your entire due diligence process. You're going to have the inspections done. And if ultimately you decide to pull out of the deal, you've got a lot of avenues to get your larger earnest money deposit. Like, there's a lot of stuff that happens after you make that first offer. And then another thing that I like to tell my clients is like what would make this a perfect deal? Like what price, what terms would make this a perfect deal for you if they're having trouble getting that first offer, like shooting off that first offer. It's all right, make this perfect. If you're not excited about getting this offer accepted, we're not going to submit it. Like what would make you excited? So go ahead, write the offer that way, submit it. And then they're like, okay, like, let's go. If this thing gets tough, like this is a killer. We just had the same thing happen on a short-term rental property in Lago Vista. Asking was $350. And it was like, all right, what's going to get you excited if this is accepted? And it's like, well, here's the terms. Here's what I would like to see. Shot it over. It got accepted at $275. Let's go. So I totally agree. Getting that first offer out of the boat is something that's really huge. Another idea that I had, or like something that helped Kendall really like get over the analysis paralysis, like I guess like sickness paralysis. It was the idea that it's not so much you're not spending this money that you've saved, right? So you're saving for the last 6 years and you've got $50,000 sitting in a checking account, right? It's $50,000 of like liquidity sitting in this checking account, of equity sitting in a checking account. When you take that 50,000 and you put it toward the down payment on that house, it's not like you're spending that capital and it's gone forever. Now you're not getting it back, right? There's a lot of avenues to get that capital back if you decide to. Like if you want to convert it back into cash, you can, right? You absolutely can. That cash is just used as a key to unlock an asset that's going to appreciate, that gives you a lot of tax benefits. Like that initial 50,000, that's a key to a larger capital stack down the road, right? So, and another thing with like that 50,000, it's not like after you put it into that asset, if you were to look at your net worth, it hasn't changed. You know, your $50,000 in cash equity sitting in a checking account is now just converted to $50,000 in home equity sitting in this other bucket, you know? So like once you've saved up that 50,000 or once you've saved up that down payment, it doesn't go anywhere because you buy a piece of real estate. It just changes form. Only it changes form into something that's much more advantageous. You know, it can cash flow. You get the tax benefits. You've got the appreciation potential. It's a key that needs to be used. But if you don't use the key, you know, you never get inside. You never play the game. So like that was a huge and a game-changing conversation for Kendall and I. And as soon as that, she kind of like got that, it was like, yeah, let's go. Let's buy some of these things. We're not spending this cash, right? We're not wasting it. We're not blowing it on another house. It's just converted. Instead of being held in this bucket over here at Chase Bank, it's held in this bucket over here at 123 Main Street. So it's a good thought shift for us to have.
Love that. Love that. Building on that thought shift, we already talked about putting in that first offer, but what is your kind of first foot forward to break through that roadblock? Like there's a huge brick wall standing in front of people in analysis paralysis. What is that first swing of the hammer to break through or something?
Yeah. Knowing like exactly what it is, like what you're looking for. You mentioned why, right? That I think that's like a higher order piece. That's really high, but knowing what that deal looks like, I think is huge. And being able to say, hey, this one hits all of your boxes. It hits 8 out of 10 of your boxes. Like this is one that we should go for, right? So for example, us, it might be something like we want to walk into at least 15% equity. So we want a 15% discount off of today's fair market value. We don't care where the value was 6 years ago. We don't care where the value is projected to go in 6 months, right? We want 15% discount from today's fair market value. And that's from Gary Keller's book as well, right? The Millionaire Real Estate Investor. So we want to walk into equity. We want to make sure that it's cash flow neutral or better. So we want to know even if everything goes wrong and the market goes down the toilet, we will still be cash flow neutral or better in this asset. And then we also want to make sure that the macroeconomic factors of like that neighborhood are sound. So it has increasing population, the number of jobs in the area are increasing, and then median wages in that area are increasing as well. So if it checks those boxes, like it checked everything that I'm looking for, like what else are you really going to look for? Are you going to continue to analyze deals and to find the same thing again? Like here it is, you know, the offer, what's going to make this perfect? What's going to make me excited about this deal that checks all of my boxes? Submit the offer. What about you? What would you say?
I would almost say the same thing. I kind of always just ask them another question exactly like you just said is, if not this, or if not now, then when, and if not who, or if not you, then who? You gotta kind of understand that there's always going to be a better deal out there. I do that a lot where like it checks all of their boxes plus some. All metrics are hit and they still don't pull the trigger, or we don't still pull the trigger on something. Why? I think it comes from setting the right expectation first. You can go back to the broader scope of the whole model, I guess you can say. You know, it starts small and build up from there. So,
another idea about like starting small, another like tip I've seen people use to cure analysis paralysis has been, all right, so they're looking at a $300,000 price point, and it's like, okay, they've got questions about like, well, how much reserves should I have, and like, are my numbers going to hit? And then we go through 4 or 5 months of looking at $300,000 deals and it's not working. A technique that I've used has been to shoot over something half the price, you know. So much more palatable when you've been conditioning yourself to a $300,000 purchase and the cash outlay that comes along with a $300,000 purchase. Now look at something 150, 175. Yeah, you might have to look at a different market, right? Maybe before you were looking in San Antonio, now you've got to look at like some of the like Killeen, Temple, Belton, Waco markets, right? But analyzing numbers at a $150,000 or a $175,000 purchase price when you were already prepared to purchase something at $300,000, now it's like, okay, so if everything like goes wrong, like the relative weight of a $150,000 purchase relative to what I was already prepared to spend is nothing. So like that's so comfortable. People are like, this, I could have this thing vacant for 6 months and it doesn't matter. That's a great way to get the first deal out of the boat. And then they're like, hey, if this one works, I can just do another one. You know, I can do two at 150 and have a big buffer after that first one. I can learn a lot on the first deal at 150,000. So that thing that I saw was really effective, you know, just like reducing, instead of being like capped out at 400, go down to 2, go down to 175 and just see if that is a little bit more palatable. And a lot of times, you know, it's a lot more comfortable to people start making offers when you reduce the purchase price. So that's like just a small tip.
Definitely. That just goes to know, or it helps knowing what is a good deal in your specific market. You know, a good deal in DFW or even a good deal in Fort Worth may not be a good deal, you know, over in Lubbock, or even smaller, a good deal in Dallas may not be a good deal in Fort Worth, and they're 25 minutes apart. So, I mean, analyzing deals and seeing more deals does help you understand that what is good from bad. But I do love that, just comparing markets and price points and stuff like that. That's really good.
Something that I've been having a lot of our clients do, if they're not ready to go ahead and buy yet, like maybe after our first conversation, they're still 6 months out. I always encourage them to look at the daily deal email. Because that's going to show them the numbers every single day. Like they're going to know more about the Central Texas market after looking at that daily deal email than 95% of the investors in our market right now, just because every single day they're seeing what single family homes, multifamily homes, large commercial complexes, they're going to see cap rates, purchase prices, cash on cash return. They're going to see the quality of the inventory, short-term rentals, long-term rentals, midterms, like rent by rooms. They're going to see the entire breadth of like residential real estate just by looking at that email every day, you know? So when they see something in Dallas trading for a 7 cap and it's turnkey and it's a duplex in Frisco, they're going to say, holy smokes, this is awesome. Every other duplex in Frisco I've seen has been a 4 cap and it's been $125,000 cash outlay. This one's pretty turnkey. It's $90,000 cash outlay and it's at a 7 cap. This is one to jump on, just because they're conditioned at this point after reading through those numbers every single day. They know a good deal when they see one, just because, just like we're analyzing deals daily, looking at that email every night, they know exactly what's trading and how it's trading, and they can see a good deal when it comes through. So that's another way to really cure it, like just seeing what everything else is trading for. And then when that good one comes, you'll know right away and you'll be able to jump on it.
Yeah, for sure.
Yeah.
Love the daily deal email. I even love those, because I'm not always analyzing the San Antonio and Austin and stuff, but I still look at those suckers every day.
What would you say is an appropriate, here's something else that helps people like be comfortable with like the deals going forward is a reserve fund. Like how much would you suggest, just like a very granular type of answer, right? Like how much would you suggest, or what do you think is appropriate to have in reserves prior to closing on your first deal?
I want to say 6 months. I know, talking to a lot of lenders, they require that if you're doing a conventional investment loan, they want close to 6 months of your pity payment, your principal, interest, taxes, and insurance, just to keep the asset alive. You know, you don't need to save every single like doorknob fix or something, but I like 6 months.
Yeah. And I think that's totally appropriate. Like when I was answering this question for myself, I said 3 months of OpEx, and Bigger Pockets has the 50% rule, right? Like 50% of your rent should be allocated toward the mortgage payment. So those metrics were at the exact same: 6 months of pity payments, 3 months of operating expenses, you know? So, and that's super easy to calculate. You know, if you know that you're at a 6.5% interest rate and we know that you're putting 20% down, you can just go on to mortgagecalculator.net, see what your pity payment's going to be, multiply it by 6, make sure that you have that in reserve on top of your down payment and whatever furnishing or make ready costs you've got. And that's a awesome rainy day fund to have. And if you've got 6 months of expenses sitting in a savings account, you really feel confident going into these things. You could have the house sit vacant for 3 weeks as you're trying to get it leased out. You could have a fix right out of the gate and you're covered. Like you've got the cash on hand to go ahead and cover those expenses. So I think 6 months pity is perfectly appropriate.
Yeah. How do you calculate your pity payments?
So I personally, I just use mortgagecalculator.net. That's it.
Nice. I use Carl's Mortgage Calculator. It's a little app. It just looks like a normal calculator, but usually perfect or right in line when we ask lenders what's our projected pity payment. Carl's mortgage calculator works great.
Yeah. So what's it called? Carl's Mortgage Calculator?
KARLS, Carl's Mortgage Calculator.
Oh, sweet. Yeah. I mean, we pretty much know what the insurance in a market is going to be. You know what the tax is going to be right off of the tax record.
Yeah.
And then your principal and interest is just a function of down payment and purchase price and interest rate. Not super difficult. So just punch it into Carl's calculator or mortgagecalculator.net and it'll pump out, you've got $1,500 multiplied 1,500 by 6. And that's a very appropriate reserve fund to have a bucket off to the side.
But I like that little tool, and a lot of clients like it a lot when I tell them about it. Just while they're scrolling through Zillow at midnight, they can kind of do all their payments, see what's worth actually pursuing.
Yeah, I got you. Cool. Well, we're at 7:30. Was there anything in addition that you wanted to hit on, quick tips, or if you wanted to do anything in any like other concerns or questions that you wanted to go over about the analysis paralysis topic?
No, we pretty much hit everything. Obviously, it starts with the greater picture and we're on a deeper level, the why are you doing things? Everything needs to start there. Like I said earlier, you don't really get to the analysis paralysis stage if you don't have your why. Like, real estate is the ticket. How to do it. Like Gary Keller says, like it's not rocket science. And you mentioned that earlier. It's very easy. And usually you have your model and you know what kind of properties to analyze. So from the deep spiritual level, I guess you can say, your why up to like the actual how to do it, but really just wanted to talk about what the first like hammer to the wall to knock down that sucker was. And I think we covered that.
Definitely. Just making sure that you have a good understanding of like what exactly it is that you're trying to find, make sure it marries to the why, and then just understand like, because you put the $50,000 toward an asset, it's not gone. It's just it looks different, so you saved 50,000. Congratulations. You're ready to jump into the game, take down the first deal. If you hate it, if all goes to hell, go ahead. You could sell it. You could and pull that equity back out, put it into the stock market if real estate isn't your thing. But it's not disappearing. You're not spending it. It just looks a little bit different. It's a key that helps to unlock a high growth asset. So
that's my favorite part this morning. I'm gonna use that a lot.
Yeah, it's good.
That key to open up that life-changing avenue of real estate.
Yeah, it's good. Cool. Awesome. All right, dude. Hammer down. We'll touch base on Friday morning then and keep rocking. Okay.
Yes, sir.
All right. See ya.
Peace.